really to dive into strategies when it comes to building wealth and increasing passive income. And we obviously talk about a wide range of different topics. We obviously have a lot of different investors in here, people who invest heavily in real estate, some crypto, and different asset classes. But today we're going to hear from Joel. And Joel's been on a fun journey the last, how long have you been in the real estate space for?
About 17 years now.
17 years. And obviously, it sounds like this has been the foundation to your wealth building career. Is real estate's where it all started. And so excited to hear from you and really just dive into how do we fortify our wealth. And so this is going to be an open collaboration. And I know you've got some fun stuff prepared, so we'll jump right in.
Awesome.
Joel.
All right. Any of you who know me know I'm not a very serious person. All right. Can you guys hear me all right? If you know me, I'm not a very serious person. I was going to play a little clip that I was talking to Dan about as I was preparing for this. You want to do the second one? Yep, that one.
What you just said is one of the most insanely idiotic things I have ever heard. At no point in the rambling, incoherent response were you even close to anything that considered a rational thought. Everyone in this room is now dumb for having listened to it. I award you no points, and may God have mercy on your soul.
I don't know if you guys have seen Billy Madison before. It's a good movie. I was envisioning Shoney standing up after my presentation and saying that. Hopefully I'm wrong. But anyway, so one thing I am very serious about is keeping track of net worth, wealth, whatever you want to call it. So if you've been in the business long enough, you realize eventually real estate starts to become a grind. Like, it's very fun and interesting when you first get into the business and you like working with clients, and eventually you find yourself at some point getting burnt out, whether that's from production or the market change like we're going through right now. So I got into real estate right before the last downturn, and it was a hustle. I had to learn how to really work hard, be very good at customer service, and really learn how to keep deals together, because if you're closing one deal for the month and that's your paycheck, you can't let that deal fall apart. So I became, out of necessity, really good at tracking my budget, tracking where the money's going, and having to figure out how to work through financial hiccups that happened. So when I first got into real estate, things were going fine, selling real estate, making money. And then all of a sudden the market shifted. And the year that was the hardest for me, I think I sold 27 homes that year, which you'd think, wow, you should be fine financially selling 27 homes, but the average home price dropped. And year over year, I sold more homes and I made about 10% less income. And I had made some financial commitments at the time. I was building a new house. I was putting in my landscaping. I'm doing all this stuff thinking like, okay, I can burn through some of my savings. I'm going to be just fine. Not realizing that, hey, the market is shifting and my income is drastically changing. So for me, that was a real eye opener as far as needing to track my money, what's going out, what's coming in, and really get serious about my financial future. So I would say my wealth journey really started out of pain and forced me to evaluate all of my finances. And I'm sure, right now, there's a lot of us that are going through that. So we as an ownership group went through a top-down production sheet on Tuesday. And it was surprising to me, and I'm sure Shoney can attest, how it's not from lack of effort. We have an agent in our office that's in at 8 a.m. and out at 6 p.m. and he's calling every day. It's not by lack of effort, but the transactions just aren't happening, which is translating to obviously a lot lower income. So what I wanted to talk about today was basically foundations of financial strength. We had a mastermind this week at our office that covered some of these topics. We try and mastermind as a group to help our agents make sure that they can weather this storm, and not just weather it, but have success. And one thing that I would say is, as I hit some strides on my wealth journey, I've tried to mentor other agents in the business to help them learn from the mistakes that I've seen people make or mistakes that I've personally made. I'm not ashamed to say it took some time for me to get this figured out. I look back on my wealth journey and there's things I would have done differently. In college, I thought I needed a brand new truck because I got and started a business and I'm like, yeah, I need to look successful. I need a brand new truck. I'm a new contractor or new in real estate. And so I went and bought a brand new truck. Get married. I'm like, got to give my wife the same lifestyle she's used to growing up. My dad was a dentist. Her dad was an engineer. And I'm like, we got to buy our first house. Nowhere in that was like, how am I going to afford how to pay these bills? And one thing that, as I've talked to some agents in our office or other offices, I was actually quite surprised how few people, even though they might be pretty far into their wealth journey and successful agents or actually have a decent net worth, they don't know their numbers. They don't know their budget. And so that's something I wanted to talk about today, understanding a little bit more about how much you need for emergency funds. I know some of these things are going to seem basic, but I was quite surprised how many people don't understand the basics of financial security. One thing that I think conceptually is wrong, if you were to go and Google, like, how much money do you need for an emergency fund, 3 to 6 months? I think that's wrong. And the reason being is I think that model is for someone that is employed. We're all self-employed. We don't know when our next paycheck's going to come. Maybe we have a spouse that has a job that provides some stability. But I think that advice is for someone that has a job. They're used to having a historical income. And the internet's going to say, you need to have a rainy day fund of 3 to 6 months in case you lose your job, because you're probably going to get employment again within the next 3 to 6 months. There's been times where I didn't get a paycheck for 3 to 6 months. And I know right now from looking at the production that I think a lot of us are probably negative cash flowing during this time period because we're not adjusting our expenses and our income has definitely adjusted. So that's something hopefully that you take away from this class is probably need to evaluate that. 60% of Americans lack even $1,000 in savings. I don't know where everybody's at in their wealth journey right now. I've been there at the lowest point of my career. It's a story that I will tell and share. I remember when my 13-year-old was about to be born and I was scared out of my mind. I had a $1,600 mortgage. I had $10,000 in credit card debt, and I had a couple $1,000s in the bank. Like I don't even think I had enough to make my mortgage payment that month. And that was the scariest time of my life. And I made a promise to myself that I would never go back to that, never put my family in that situation. And so it really forced me to evaluate my financial situation personally. I refinanced every debt that I had. The saving grace in that scenario was at least interest rates were lower at the time. So I remember refinancing vehicles, student debt, my house, anything that I had a loan on, I was refinancing to try and drop that payment. So much so that Wells Fargo called me and they're like, what's going on? Like, why are you, it basically looked like I'm in financial trouble because I was having so many hard inquiries on my credit. And so for me, that was a very scary feeling. And if any of you guys are in that position right now, come grab me after. I'm happy to talk you through how to hopefully pull yourselves out of that, because it was the scariest time of my life. So the best thing that I did was sit down with my wife and create a budget. And I am extremely granular on my budget. I still have an Excel sheet broken down to how much we're budgeting for medication for the month, or a doctor's appointment, or dentist, or I have 4 boys, haircuts. It doesn't seem like a expensive thing, but when you have 4 boys and it costs $30 to get their haircut, it adds up quickly. I've got subscriptions. I've got all of the Disney Plus and Hulu and all that stuff broken out, because I think we probably underestimate what we spend a month. And the only way that you're going to be able to save and get ahead is to actually sit down and get super granular with your expenses. I put together a handout here. I don't want to go over it super in depth. I want to try and hit some of the deeper topics that I think you guys will benefit from. But essentially, the rule of thumb is 50% of your budget should go for needs like utility bills, rent, mortgage, healthcare, groceries, the things that you can't live without. The other 30% are wants, things like subscriptions. So when we were having financial difficulties, the first thing I did was I'm cutting cable, I'm cutting anything I possibly can out of that monthly bill, even if it was $15. Because I remember one time my wife wanted to go to a Christmas party. It was the holidays. And it was the hardest thing for me to say, hey, we literally don't have enough money for you to go and buy a $15 gift to go to a gift exchange because we just don't have the money. Those are the tough conversations that you have to have, because the conversation is going to happen whether you want to or not. It's easier to have the conversation before you get into financial trouble than after. So I know this sounds funny. I was just having a conversation with Shoni. I have a budget for vacations. So I like to travel. So part of my budget is I have a monthly allocation for travel. It's very much planned out. If you were to look at my notes in my phone, I have all of my travel booked out for the rest of the year. I know what I'm doing, where I'm going. And so I can say, all right, if I want to go on this crazy vacation, I'm going to budget for it in my yearly and monthly budget to be able to afford that. Not just, I'm burnt out, I want to go on a vacation and I haven't planned financially.
Maybe you're going to answer this, but how much time do you spend in your budget? It seems like it would be a huge time sink.
I actually don't spend a ton of time in my budget because what I was explaining the other day was, so I created this budget, and for me, the way I would track it in past was I use like Mint or another app, and I found that to be super tedious because then I'm having to categorize things. So what I would do is I would say, this is my budget. This is how much I need monthly or yearly. And then I would track it basically, rather than getting super granular on, did I stay on my food budget? Did I stay on my travel budget? I'm going to look globally and say, this is how much money I had in the bank at the beginning of the month. Did I stay on track to follow my budget? I might have been over on food and under on travel or something. I didn't spend a lot of time to get granular on where I was spending the money unless I wasn't staying on budget. If I was on track, then I'm not going to go spend the time to track every expense. If I was over budget, then I probably need to sit down and go through the pain of tracking the expense. That's what worked for me personally, just because it did become super tedious and I didn't want to spend a ton of time on it. And so I created the budget, and then I'm like, I know I have this much money to spend each month. And then I just evaluate it on a monthly basis. One thing that works for me as well as the majority of the stuff that I pay for, I put it on a credit card, not because I'm wanting to rack up debt. It's because I go in probably every 2 or 3 days and pay that credit card, and I can see how much money have I spent. And if I'm like, wow, that was way more than I thought, and that was painful to make that payment, then maybe I need to evaluate, and I kind of make those kind of adjustments as I go along during the week or month, rather than getting to the end of the month and going, crap, I overspent by $5,000. I can't really go back and adjust for that at that point. So I try and do it just every couple days. If it's way more than I anticipated, then I'll look at my credit card bill and I'll evaluate, where am I going really out of control on expenses? That's just what works for me personally. But this is the advice as far as the percentages. The other 20% should go towards savings, put into your rainy day fund, or into maybe a lot of my liquidity right now is just in Merrill Lynch. So I put it in, it's better than a high yield savings account. It's in cash and I can get about a 4% return on it, but I can get the money tomorrow. So it still gives me a decent return and something that I can get to quickly. I have other assets that are paid off that I could get a line of credit on. But to me, I don't view that as nearly as liquid from an emergency standpoint, because in the last market shift, I saw lines of credit get closed on real estate because banks are like, hey, we're uncomfortable with your financial situation, or we're uncomfortable with the economy. So that line of credit that you thought was available is no longer available. Yep.
How much are you said 20%? How much are you leaving in that 4% account that's basically liquid versus your other net worth where you can get a lot higher returns on investment?
So it depends, and I'll clarify that. So Johnny texted me recently. He's like, how much of your net worth is liquid at any given time? I haven't followed a general rule of thumb. It's been more a gut check of, do I feel comfortable with this amount of money in the bank? So I would say it's about 10%. It's probably on the higher side of what most people have liquid. About 10% of my net worth's in cash, because the way I view it is, if I'm going to go out and take other financial risks, I need to have more liquidity. If I don't have a lot of risk, then my liquidity can be lower. So I do development by profession, real estate development, construction. So I have businesses set up that have cash in them for a rainy day fund. And then I have the like parachute of, if we burn through the business cash, do I have personal cash? That's what gives me comfort, just because of the position that I've been in the past, and helps me sleep better at night. So through the ups and downs, I probably had $20 million of development debt over the last few years. I had several large developments going, and at this point, I just don't have that development debt, so my liquidity doesn't need to be as high. And so I would evaluate it from a risk perspective. So when I hired a real estate coach, part of what we analyze in there is bulletproof level. Like, where do I want to be from a bulletproof level? If something goes wrong, like, where's my risk? And so I think if you're doing high risk investments or higher risk, more susceptible to a market shift in the niche that you have, then I think you're probably going to have more liquidity. For example, let's say your business was very niche in Airbnb, short-term rental. That's a market that could get disrupted pretty easily, right? I view the real estate like an investment. If you're diversified in your business, as far as the types of businesses that you do, you're less likely to get disrupted in a market shift. I went out to lunch this week with Becca, with an agent, and she was very focused on working with investors, and her business is slow right now because a lot of investments don't pencil right now with interest rates. And so her business is slower. So if I were her, knowing that, I would say, all right, I know I'm very niche in my business. I probably need to have higher savings than someone else, because I'm taking a little more risk in my business because I'm not being as diverse in my business. It's the same way with investments. If you were like only focused on one aspect of real estate, you could get disrupted in your investment or stock or whatever it is. So I would just evaluate the risk level that you have in your business or investments and see what's personally comfortable for you. My business partner, Brad, he's more comfortable with less cash, and we both have paid off assets, and he feels, hey, if I needed cash, I could go and leverage against an asset to get the cash. And I'm just a bit more conservative, and I don't want to go into debt to get access to the cash. So I keep more cash on hand. But everybody's different. So that's the model. I can say budgeting has really helped me to invest in my career. The best investment I've been able to make is to invest in my business. And what I mean by that is 3-4 years into the business, I had an opportunity to get into new construction. So I had a builder that wanted to hire us. He wanted to go out and start from scratch, and felt like he could grow this business. That meant that I was going to have to shift a lot of my focus from working with my SOI to really trying to grow his business, which, if you guys know construction, takes a while to get paid on that. So even if I had a client today, I'm not getting paid for 6, 12 months. And so I had to have enough money in savings to where I could go and say, I can afford to take that risk to better my career because I'm not going to get paid for 6 months. And had I not had the savings to be able to do that, it would have drastically changed my opportunities in real estate. I had that client for 12 years, made great income from it, and I would have been super limited in my opportunities had I not had that kind of buffer in my savings to be able to take advantage of that opportunity. All right, you want to go to the next slide? So I assume a lot of you guys have seen something similar to this. Basically, this kind of explains knocking out debt, the debt snowball versus the debt avalanche. I can tell you what personally worked for me. Everybody's going to be different, and I analyzed it from a little bit different perspective than what this explains. But one of the most important things I could say about financial security is getting out of debt. And I'm not trying to offend anyone here, so take it for what it's worth. I'm just going to give you my personal opinion. It's worked well for me. Car debt is probably the worst thing that I felt like I had. And the reason I say that is I probably had, and this is probably not even a lot of money considering what a car costs nowadays, but when I had car debt, I probably had $1,200 a month in car payments. So nowadays, the car, $70, $80, $90, $100,000, like your payment on that would be probably $1,800 on a car payment. And I know it's easy to justify and say, yeah, but it's a tax write-off. So I'm going to go buy this car and have an $1,800 payment because I'm going to save $15,000 on my taxes or whatever if you're buying a new truck. I've gotten sucked into that before, and the justification, it just never pencils long term. So what I did was I analyzed it. I said, all right, I want to get into my next house. I want to get into a bigger home. I've been in real estate a long time. I want to upsize my lifestyle. And I analyzed it and said, here's the debts that I have $1,200 of car payments. I have a student loan, whatever it was at the time. And I looked at it and said, $1,200 of car payments on a depreciating asset is, to me, wasn't a good investment. It wasn't an investment. So if I could take that car payment, pay off the car, and flip the debt into real estate debt, then now I'm buying something that's an appreciating asset. By the time I had a mortgage on the home, it created a tax benefit for me. And so I took depreciating bad debt and flipped it into appreciating good debt from a tax perspective. So that $1,200 truck payment or whatever that I no longer have that truck, that's nothingness to me. I still live in the house. In the 6 years that I've lived in the house, it's doubled in value. That truck did not double in value. And so that's why I'm saying if you can get rid of car payments and analyze whether you can take that $1,200 and pay down debt with it, or you can afford to now go and invest in real estate because now you've freed up $1,200. It's not that hard to knock out car debt. Let's say you have $50,000 of debt on a car. You can probably knock that out in a couple of years if you just buckle down. So the way I analyzed debt was, can I get a tax advantage from it? If I can get a tax advantage from it and it's not killing me, for example, I had a $25,000 student loan at the time. I evaluated it, like the payments, like $85 a month. I am getting a tax benefit from it, and it was one of the lower interest rate debts. I'm not going to focus on that one. So what I focused on to knock out my debt was, what can I take the least amount of money and make the biggest impact? And so at the time, the biggest impact, least amount of money to pay off was cars. I took $20-something thousand. I'm like, I'm going to laser focus. That $20,000 is knocking out a $600 car payment. It's very easy to analyze. $20,000, knock out $600. I can analyze my rate of return, and it's a very high rate of return relative to the amount of money that I'm taking. And so I just went through all my debts and analyzed it. And then I came up with an order of the things that I wanted to pay off. And then as I was freeing up that $600 a month for the car payment that I no longer have. Now I can take that $600 and pay it towards another debt. And it was crazy how fast I was able to get out of debt by just strategizing and buckling down. So this debt avalanche versus snowball, it's prioritizing balances, paying off the smallest debts first. Again, there's models. I would do what works best for you, but there are models such as this that give you some examples of how to do it. But that's what's made the biggest impact in my financial future. And the reason being is when I knocked out the debt, banks were knocking at the door to give me loans on development or projects that made me a lot of net worth. And when you have a lot of debt, banks look at it and go, well, you can barely pay your bills on a monthly basis. We don't really want to loan you $10 million to do this development project. So I think getting in a position where you can get into good debt will help you grow your net worth. The majority of my net worth has come in the last 5 years, which, a lot of it's due to timing, but it's crazy how fast you can grow your net worth when you can start putting money into investments that just have time to grow. All right, you want to hit the next slide there? So this is probably one of the most important things to me in wealth, and it's risk mitigation. So you guys can stop and ask as many questions as you want. I don't want to just be up here talking. And the reason I say that is one thing that I learned from an individual who's is a client / partner of ours. His example helped me analyze things differently. He's worth 400 to 500 million. He looks at ways that he's going to lose before he looks at ways that he's going to win. So instead of looking at a prospective investment as, I can potentially make this large sum of money, he looks at it and says, how much money could I lose if this investment goes bad? If he gets comfortable looking at the bad side of things, then, you look at the good side and the upside, because things can go bad. And when they do, they generally go really bad. And so risk mitigation, I know, Johnny, do you have a Utah Asset Protection Trust? Or
Domestic asset protection trust for my house.
yeah, do you know what a Utah Asset Protection Trust is? It can be for cash. It can be for
General revocable trust.
Okay, so one thing as I started to grow my net worth that I would advise is find a good estate planner. So we found a good one in Provo, very expensive, cost me $30,000 to set this trust up. But I looked at it and said, what am I losing if something goes sideways and my assets are not protected? I would have rewound the clock and said, hey, I'll pay you $150,000. Whatever the number is, I'm going to lose way more money in net worth if something goes sideways than the money that I spent to set this trust up. So a Utah Asset Protection Trust is basically the most secure trust you can have. It protects against IRS tax liens, divorce. Something that was weird that I had to do in setting up this trust was it was basically a pre-negotiated post-nup essentially. So all of my assets are in my wife's name. I don't own our house. The money, the real estate assets are in a trust. It's in my wife's name. Reason being is if I get sued, this asset protection trust, I can simply say the trustee will not sign off on relinquishing these assets. Sorry, I personally don't own anything. You can sue me if you want, but I have zero net worth personally. The trust has a lot of money. And so generally speaking, as you started getting into these, if you're in real estate long enough, you're going to get sued. I've been sued 2 or 3 times now over stupid stuff. The most recent one was I got served at our office over a apartment complex that we owned a couple of years ago. The attorney was not super bright and he sued the wrong person. So I didn't even own the apartment complex anymore, but I still had to spend a couple $1,000s to go through and hire my attorney to deal with it, just to say, listen, I provide you proof the time that this guy slipped and fell in the parking lot. You're suing the wrong individual. So People are very litigious. In that scenario, somebody who didn't even live at the property, was a visitor, came, slipped in the parking lot, got injured, and decided to sue like 15 months later, said he missed work and all this stuff and was injured. And I had that instance. I've had 2 deaths on our property. I had somebody slip and fall and die on a development that we did, where Ryan texted me one day, hey, you better give me a call. This lady was taking her trash out and she was short. She put a stool up, stood on it, fell off the stool, hit her head and died. Had another situation on rentals that we owned where a daughter murdered her dad. SWAT team came. Crazy stuff happens. And I've only been in development since 2016. So those are pretty heavy things. Those are the like gut clenching, oh crap, do I have everything in order? Do I have my assets protected enough that if somebody comes at me for a wrongful death lawsuit, is it going to bankrupt me? So I don't want to scare you guys, but I think it's as important to protect your wealth as it is to make the wealth. The last thing you want is to work your whole life to have somebody sue you to take it away over something frivolous that you could have avoided. My house, all my real estate assets, majority of my cash. I probably have 4 different trusts that I have set up. I have different trusts depending on what types of assets go in there, but you wouldn't want to put like your business cash in a Utah Asset Protection Trust because it's just a lot harder to move around. But there are different types of irrevocable or revocable trusts that you can set up. Every project we do goes in an LLC. So every time we go and do a development, we have a new LLC that we create for that specific purpose. And then we close it once the project's done. We wait a year just to see if anything pops up and then we'll close it.
Kind of along the same lines too, like each property that you own in an LLC, or are they just
I have an LLC and then the trust owns the LLC.
do you have a specific one trust that owns each LLC, or do you have an umbrella?
One trust would own the LLC. So I have different LLCs depending on
You don't put multiple properties under one trust.
it's under one trust, but different LLCs. So depending on the development that we do or the rentals that we own, I have some in Springville, they're under one LLC, some in Spanish Fork, they're under a different LLC. And so they're all under the same trust. They're just different entities.
But they're in a series of, so like they'll buy one LLC.
No, they're all separate because it's been years of, yeah.
They allow it's called a series.
Yeah, that's what she is saying. Yes, I should look into that because I have 10 different K1s that I get every year. It's a pain in the butt. But so I would say talk to a good attorney. Get a good attorney to help you set up your risk mitigation, because this stat that I saw was super scary. 32% of foreclosures stem from uninsured losses. It doesn't go into detail on that, but I would say this: an uninsured loss could be like medical bankruptcy. So you don't have good enough limits on your health insurance, or you don't carry health insurance. A lot of people don't carry life insurance because they're like, I can't afford that monthly payment. So let's say if I was to pass away and I am the primary breadwinner and I didn't have the funds, you could have a foreclosure just from a death of a spouse. Natural disaster. Yeah, you think about fires and being underinsured and you have a mortgage and all of a sudden you can't live in the house. I think that's a super good point. Disability. Like I got in a really bad biking accident a couple of years ago, and luckily I was in a financial position where I couldn't work for months on end, and it didn't disrupt me financially, but it very well could have. I think back and I'm like, man, if I hadn't made a few of these tweaks in my business, I could have very well put me in a bad financial situation to not be able to physically work. Those are things, and I don't have disability insurance, but I think it's probably something that's good to have. But that's one area that I probably need to look into of what would happen. I'm essentially self-insured at this point. I have enough savings that even if I couldn't work for the rest of my life, I'd be all right. But a lot of people don't have those things in place. And that's something that I would say disability umbrella policies. I have a friend recently that his son helped someone that got in a car accident. And about a year later, that person got an attorney to sue because they claimed that him moving that individual may have added to her becoming paralyzed, because she did become paralyzed from the accident. And this wasn't even someone that he knew. He came across the person, was trying to be a good Samaritan, and he's a teenager, and they ended up helping this girl. And now it's going against the homeowner's insurance policy of this individual. Their child that's 17 years old did that. No way in a million years would I think my son is going to get me sued over trying to help someone in a car accident. But it happens. And so he has, luckily, he's got homeowners insurance, and then he's got an umbrella policy that will likely kick in. And the insurance company said, yes, it's likely to get settled because they just don't want to fight it. So crazy stuff like that happens. I've seen people get killed on job sites over just freak accidents. And so risk mitigation is extremely important in your business. I would say a lot of us, we understand we need to get buyer brokers signed. We need to get all sorts of documentation signed in the real estate side. This is how you protect yourself on the personal side, by diversifying your assets to spread your risk. I would say I'm heavily invested in real estate. I've tried to invest in other stuff, and it just, every time I get them out of my lane, it doesn't work. So I would say the majority of my net worth is in real estate and cash, but I try and diversify the types of real estate that I own. I have some industrial development stuff I'm doing. I've got commercial, and then I have residential. And then above and beyond that, I try and spread into different locations so that it's not like all of my money is tied up in one specific asset class in one specific location, because I can tell you from owning different rentals in different locations, it's okay, great. Another apartment complex got built in the city, and now there's more competition and my rents adjust some. And so I think it's important also to diversify location and asset class within the real estate that you own. I don't know. What do you guys think? How are you diversifying, Shoni?
We just talked about this maybe a month ago. Johnny and I went to the Platt Finance event with Tony Robbins, and he had Ray Dalio, Steve Forbes, some very successful individuals. And I went to this event last year in Canada, and I was probably 98% like real estate. Most of my network is tied up in real estate, until Ray Dalio said that you can actually reduce your risk by 80% by having 8 to 12 uncorrelated assets. And so now I'm in 3 primary assets classes, but my focus is just saying, how can I, and there's different stages of your wealth building journey, but up front, it is all about concentration, making sure that you're focused on one lane where you can really hyper focus and build that skill set of investing. And then over a certain stage of your investment journey, you have to look at diversifying to protect your wealth. And so for me, the last 12 months has been a focus on how do I get into other asset classes. Crypto's been another big one or focus for this last 12 months. And so, yeah, just trying to spread it out, but mainly similar to you, just diversify within different real estate asset classes in different locations. So stuff in Texas or Utah, trying to diversify within different states within the US, but then also different categories of real estate.
That's awesome. Yeah, that's something I would say from personally, and then also just having a conversation yesterday with an agent that I went to lunch with, is something that I feel very passionately about is staying in your own lane. And what I mean by that is Shoni, I'm sure, has a lot of knowledge of crypto, has probably spent a lot of time in understanding that. And that's why you're diversifying into that, because you feel comfortable, you understand it. That's why I feel comfortable in real estate, but I've gotten into crypto and I've lost a lot of money getting into crypto because it's not something I understand. I don't understand the risks that I'm taking. I see other people making money in it. A business partner that was doing really well with it, and I invested money because I wanted to increase my growth pattern and it bit me. And I learned a lesson and I'm like, all right, I won't do that again. And there's been a few instances where I've done that. And that was the conversation I had yesterday with an agent. I invested a couple $100,000 with a friend in a business and it went poof. And his learning lesson was like, hey, I should have done more due diligence, should have probably not just trusted because he was a friend, and a tough learning lesson to lose that money. It was avoidable. So I personally try not to invest with friends, ruins friendships, and I think clouds judgment in the sense of your due diligence. So I try not to invest with friends. If I make friends because of the investment, that's awesome, but I try not to invest with friends. And then, yep.
You buy rental properties out of state?
I don't. And I honestly, so a little bit about my background. I've owned 135 rentals over the last probably 6 years. The furthest that we owned was in Ogden, and it might as well have been in Idaho because Ogden, an hour and a half drive, I'm not going to check on it. I like to be able to go and drive by my rentals and check on them. I'm pretty OCD with how the units get turned and making sure that it's in good shape because I think it affects my rents. And I just wouldn't do that in another state. I'm not going to go fly there. I'm reliant on my property manager. And I don't know what your guys' experience with property managers has been, but I've found the best of the worst. None of them I think are amazing, and they don't watch my money the way that I do. And so I like to be able to go and visit the properties on a regular basis to see, okay, if I have vacancy, why? Is the property being maintained? Does the grass look good? Are tenants happy? Why am I experiencing these vacancy rates? And generally speaking, there's a very obvious reason, because it's not being maintained the way that it should be. And somebody doesn't want to live here because of that. So it's mainly because I don't understand the markets either. It's hard for me to do due diligence on something because I think real estate can be hyper focused to a location. Because if you're buying a rental, let's say, for example, in the river bottoms in Provo, it's not the same as buying a rental in West Provo by the airport. And how are you going to know that if you don't live there and know that market? I was talking to Susie Clyde. She said she bought rental out of state because her daughter was going to live in it. I think she's maybe going to school out in the Carolinas or something. And she's going to sell that property because what she didn't understand was when her daughter was living there, the taxes were based on an owner occupant rate. And because it's a vacation area, when her daughter moved out, it's no longer owner occupied. The taxes went drastically up because they want to encourage owner occupants to live there. So the numbers don't work in that scenario. So she's going to sell it. I just think it's a lot harder to do your homework out of state. The other thing is a lot of the attractive cap rates that you're seeing in Texas and some of these other states where you can buy property cheaper. Yes, the cash flow can be attractive, but those are not markets that generally appreciate. So you're buying something that stays pretty flat. You're buying a piece of real estate that you hope is going to generate you enough cash, but my goal is different. My goal is to get appreciation on the property, get the principal reduction, but also get the cash flow. And that's why I like Utah. We appreciate well. Our cap rates are still pretty good. Might not look as attractive as, for example, Texas, but
You mentioned Texas. Do you own real estate there, Reynolds? Yeah, so similar. I learned the hard way. I bought 4 single-family properties in Alabama and had a nightmare. It's just his 2019 timeline. All single-family, all separate units, and it was tough to keep or find a actual good property manager. So that was the biggest challenge that I ran into. And then also just like the quality of tenants, very different in other parts of the country. So that's something to pay attention to. Is like Utah or West with like really good renters. That's just the kind of dynamics that we have here. But in Texas is a 150 unit apartment complex. So we have management on problem. So it's very different dynamic than like single family units, where you've got to be very particular about property management. You've got place and kind of a support structure. So
yeah.
I think we've had 5 years ago, I think we had probably somewhere around 20 of our agents that have purchased things out east. I think up to this point, we probably have about 75, 80% that have unloaded them since. Because a lot of times when you're running the analysis specifically on that property, it seems cool and appealing, but then everything else that goes around that, the is not, whether it's the vendor team, you're not being close to the asset, but it's just you underestimate the time and energy and even business cost administration to run that out of state. So I just would recommend not doing onesie twosies. If you're going to go into another state, go big. Just don't do the 1 or 2 rental thing. Even little things like technically you're supposed to file a state tax return where that rental property is. I think almost none of our agents have done that because they just didn't know. So a lot of it's just the liabilities out there.
Yep. In the 135 units that I've owned, I don't think I've ever had to evict someone. Through COVID, I had 2 people self-evict just because they couldn't make the payment and they just moved out. Culturally, it's just different here. You've got a predominant religion, and if somebody can't pay their rent, chances are they're going to the church and saying, hey, I can't pay my rent, and the rent gets paid. Or they have family members that are fiscally responsible. They've saved for a rainy day. I don't know if you guys know Max Property Management. They were created based on FIG, Fourplex Investment Group. So FIG's done thousands of units, Utah, Texas, Arizona. They pulled out of Texas from a property management standpoint. They just said culturally, people don't feel the obligation to pay their rent. It's just different than Utah. They're like, yeah, I'm not paying that. Versus here, I've just never had that issue. So knock on wood. You're good. Not. That's what the point is.
What is the guy looking to invest in rentals where Utah is just so expensive? You can't cash flow hardly anything with interest rates and stuff now. Whereas you look at out of state stuff, and it's okay, yes, that does pencil, but then if you don't have the correct systems in place, obviously it can burn you. Well, what do you do now? If you've been in the business a long time, so if you bought a house, you got a bunch of rentals in 2014, 15, well, you're sitting really great on them and you're cash flowing them. But what do you do now in 2025?
So one of the things that I look at, because I'm a big 4 benefits of real estate. What's the appreciation, return of your down payment? What is the cash flow return? What is tax deduction? What's the debt reduction? Like running all 4 of those cash returns on my money. And yes, out of state, there has been a better cash return, even get to the 1% of rent of a purchase price or something. For me, the natural answer, because I'm a big buy-in on Utah, like our appreciation has been phenomenal. If I were to put my money in Utah the next 10 years, it would also the appreciation return of my cash return compared to Georgia or Indiana or whatever still tends to be one of the reasons that those numbers make sense because those purchase prices have just not really gone up over the last 10 years. So that's a major non-advantage for me or disadvantage of just the cash return. For me, my thing's just partner up. Like, all right, if you're going to go buy a $200,000 house somewhere versus $400,000 here, just own half of it here. Get that down payment maybe a little bit bigger to just bring the cash flow up because again, appreciation is going to have a higher cash return. Even if I get to break even by partnering up 50-50 on a year, makes more sense than if I'm cash flow a little bit, in 100% of 200,000 rental. That's usually my logic.
That's exactly the conversation that Becca and I had with an agent that she deals mostly with investors. And she's saying, I'm having a hard time getting investors to buy off on things. They may not have the money to pay cash for it. They have $80,000, $100,000. And that was the suggestion that I gave. Go find someone that can partner with them because your cash on cash return on something that you can buy in Utah right now, like you can go buy an edge condo for probably less than it costs them to build it right this second. Stuff is on sale. It's not just for sale. There's good opportunities out there. It's just the opportunities to leverage in this market. You're going to negative cash flow. Even if you're putting down 40%, your cash on cash is going to be depressing. But if you can pay cash for it, you're going to get a pretty good ROI. Good time to invest. There's another thing called syndication, which is essentially you're getting into a massive partnership group and you lose control. But if you're like, I got $50,000 I want to invest and you want to get into real estate, there's other opportunities that you can essentially pool funds to buy real estate.
Yeah, well, one thing that I'd say too is you got to decide, like, when I do a property analysis, especially here in Utah, you want to look at not just the first year negative cash flow. You want to have a projection of year 1 through 5, but then also beyond if you plan on holding it longer than that timeline, and asking yourself at what point does it turn cash flow positive, right? Where we know the mortgage is locked in, but typically rental rates are going to increase, right? And so your costs are fixed. And so usually when I pencil things, they're usually about year 3 is where it's going to be break even. And so what I'll do is say, what's the negative cash flow for that 3-year period? Usually it's like maybe $9,000. So going into the investment, I'm saying I'm going to put another $9,000 aside going into this with negative cash flow. I personally, this is my investment strategy. I'm fine with eating that negative cash flow just because I can do it lifestyle wise, and say, okay, one, it's a tax write off. Two, how much am I getting in appreciation, even if it's at a 3% on that property? Let's just say it is a condo, right? At $3,000 or $300,000 purchase price. What is a 3% return on that appreciation? It's $9,000 a year, right? So I'm already getting that cash flow back in year one. But that's where if you look at the 5 years to 10-year timeline of holding that property, it's significant higher ROI. Some of the properties in Alabama, they'd be $600 cash flow per month, but it was high noise. There's a lot of issues that would be run into with these properties. So over time, I decided I want less noise, far more sound rental properties where I have good tenants. I don't have a lot of overhead when it comes to repairs and maintenance on these properties, but I'm benefiting massively from appreciation because Utah's not been 3%. That's a very low conservative number. Usually it's 5 to 7% in the high areas. For me, I've looked at, well, over 5 to 7 years, I'll make significantly more on appreciation, the debt pay down, the tax benefits, than trying to get a couple $100 extra per month in cash flow.
Yep. And to your point, I've made more money in tax benefits at times than I do in cash flow. There's accelerated depreciation that as a real estate professional, most of the time you can take advantage of through a cost segregation study. So especially when you're talking these bigger projects, there can be some massive tax benefits. And also just analyzing where you're at in your wealth journey. So when I first started, I was still in a lot of production. I didn't mind working super hard in real estate to cash generate. And all of the money that I was making from buying rentals was for long-term net worth growth. So my goal at the time was just get as many properties as I can. I wasn't necessarily as concerned, even though I didn't want it to negative cash flow. I wanted to self-sustain. I wasn't living off of that money coming in. So my goal was just to buy as many properties as I could and let the appreciation happen over time. And then when my goal was to flip that and say, now I want the cash flow, we went from 135 properties to 41, but we took all of that appreciation that we gained over the years to pay off the debt of the other units. And we did that just simply through market growth, through appreciation. And you just have to look at where you're at in the journey. If you're at the beginning, probably not going to focus on how am I going to retire off the cash flow of these 2 units. You're going to look at it and go, how can I accumulate more units to get to a point where I can retire eventually off of this?
I was just gonna say, on the investing out of state, we're currently investing out of state. And it's like Johnny said, and stuff, there's so many different parts that go into it, registering with the state. I have 2 people in the state that we're investing in that live there. So they're very familiar with the area. There's 4 of us when we get a property that evaluate it. And do we want to move forward? Do we not? My husband's currently there building out a team to do rehabs and stuff that he's on site. So it's definitely a different level than here. It's so much easier. We found one that looked great, beautiful house. We were going to buy it. And, the one guy who lived there, no, not that street. 2 streets over, yes. 3 streets over, yes. Not that street. So had we not known, we would have bought it, and it would have been a mess.
That's a good point.
Yeah, Tennessee area. Yes.
That's one of the key things. Like you have to have somebody you really trust
Yes.
when you're buying out of state, or else it's went into a lot of issues.
Yes. Yeah. Like I said, we have 2 people that live there that are helping us. So definitely different.
So I think we all value real estate agents. We're real estate professionals. I have hired people to represent me to purchase, hired people to represent me to sell. I know that sounds weird, but sometimes it's the better choice. If I'm selling a $30 million building in Ogden and somebody is very familiar and has a pool of buyers for that property, like I am more than happy to let them list my property. If I was moving out of state and I wanted to live in a specific area or I was looking for a specific lifestyle, I would hire a real estate agent to represent me. I think if you're going to go out of state to buy an investment property, don't be afraid to hire a real estate agent. You're not licensed there anyway, so you can't collect the commission. I guess you could get a referral, but I would hire a real estate agent to help you unless you do have somebody that you know and trust, that knows the area, that knows what you're trying to accomplish. I think there's a lot of value in hiring an agent that knows the area.
She's got to sick of her husband and send him
Yeah, exactly. Yeah. Yeah. You want to see what's on the next slide here, and then we'll finish up. So I'm not a big stock guy. No knock on it. If you like stocks or like to invest in into the stock market, I don't invest in it because it's too emotional for me. I don't like the ups and downs. I can tell you through COVID, my real estate portfolio in a week's period of time didn't drop 20%. My rent stayed the same, if not went up. And so it's not for me. I have a good financial planner at Merrill Lynch that he's got me invested in some stock type opportunities, but there's no downside. So when I'm investing in a stock, my biggest risk is I could get the lost opportunity of the income that I invested for that few years, but there's a relatively good upside. So there's ways to invest in the stock market to limit risk as well. I'm not super smart on the market, so I hire people to do that, but really good opportunities. And the last thing I want to say is it's all about timing. So when wealth generation can be made or broken based on the timing that you invest. So I had a very large 1031 exchange from apartment complex that Brad and I sold up in Ogden. And we were trying to figure out, what do we want to invest in? And so this was like at the peak of the market. So we sold it in April, 2 years ago, whatever. And at the time, I'm calling around trying to find a place to put this money. Everything was overpriced. I sold it at this inflated number, and now I'm trying to land money in the same market. It's a very difficult thing to do, thinking you're going to sell at a high, buy at a low. So we're like, you know what? We're actually not going to do a 1031. So we decided, hey, let's figure out where we're going to place this money. So we met with various different financial planners. They put together a prospectus showing, we think we can get you the average annual 12% return. And I'm like, man, if I can get 12% on this money, like I'm done. Like I'm not going to invest in real estate. Let's throw it here. You can manage it. I don't have to think about tenants anymore. This sounds wonderful. But as you start to read the fine print and look at the details, that return is only based on a hypothetical time of when you invest in the market. So we were this close to throwing the money in there and just being like, all right, you manage it. Had we done that at that point in time, the market shifted and dropped about 20% after. So if you look at how long it takes you to make that money back, we wouldn't have probably made that money back in 10, 12 years. We would have gone to a negative and then trying to get to a positive after that. It would have taken about 10 years based on the chart. And so I would dive super deep on your investments, understanding the timing, because timing's made my money. Timing would have lost my money as well. That's something my word of advice is understanding, like, this average can be manipulated. It all depends on where you put money in the market. If you're going back to the Great Depression, probably average 12%. If you were to go back and invest your money at the wrong time in the market 2 years ago, I don't think you'd be up yet still. I'd just make sure, like, you guys are all real estate professionals, hire the right people. I think that's the best advice I could give you. Get a good CPA, get a good attorney, get a good financial planner, and somebody that you can trust, a good network, because your network is your net worth. So the people that you surround yourself with make all the difference. Anyway, appreciate you guys coming, and hopefully you found some value in the information today.
Thank you, Joel. I wish that I had heard word for word the words that were on that initial video, so I can go ahead and
Yes, you are all dumber.
super valuable. The reality is that one of the stuff we talked about today is the stuff that some people would think is like kind of the boring side of wealth, but it's actually part that holds everything together. Like, you have to be thinking about this mitigation and understand how you're going to protect your wealth you're building it. Next month, and one thing that you just said at the end is so important, is the idea of network equity, right? You surround yourself with have a very big impact on your perspective. And that's why we hold this class once a month. This mastermind is for those who are really focused on building their wealth. Next month, we have Angie Fisher who will be with us. She'll be leading the conversation on general wealth building, especially when it comes to, she's done quite a bit when it comes to estate, real estate, properties, and out of state. So we here, we'll send out an invitation to all of you. It will be the last Wednesday of next month. So we'll see you then. Have a great week.
Thank you.